Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. Live. Lots happened in the last week, I guess, since we recorded. So we'll get into DroneShield because we talked about them, and like the next day they raised, how much was it? Like $100 and something million on top of their existing cash pile. But I thought we could kick off with the
what timing? Incredible.
Yeah, I know.
What's happened? Yeah, for those just who missed the last episode, we came back, things riding high. Yoo-hoo, yeah, all right. Like, we should have stayed on holiday.
It was the shortest bull market. Well, we'll see.
We've had our microcap bull market. Like, it lasts 2 weeks. 2 years of bear market. No one cares. 2 weeks. Oh, it's finally coming into like small caps and microcaps. Nah, who knows? Let's talk about that when the time is right too.
Well, let's just jump into what happened. So, last week markets were down a bit. On Friday, the US closed down. I think there's kind of like a weak jobs report number that's kind of in the mix of all this. But then I think the big thing is really the Japanese. It's called the carry trade. And I thought Andrew, as our resident expert on all things money, might be able to explain the carry trade to us. It is not our area of, we're not executing a carry trade ourselves, although we might understand a little bit. But yeah, I think we saw that with Japan falling. The whole Japanese, the Nikkei, the Japanese index fell 12% on Monday.
It's trading like a microcap, right?
No, rebounded 10% on Tuesday. But yeah, maybe to start with the carry trade and how that was a major factor in all this that I think at first was often not talked about, maybe because it's hard to talk about in like a newspaper because it always all about recession fears, but kind of ignoring them.
No, it's hard to talk about because I don't think anyone knew, and it's probably not a kind way to put it, but a lot of the time things happen and then like, okay, attach a narrative. What is
exactly?
it? There was a jobs report. And because when it was breaking, because I was checking my phone regularly, it's like, oh my, because like everyone, like what's going on? I need to wrap a story around this. And the story in the early stage was everyone's worried about a US recession.
Yeah.
And it's
like, didn't make any sense for that kind of panic to be so quick, right?
Yeah, I get that. But people have been calling the recession for a long, long bloody time, right? And so that was really weird. And the other thing that was weird, we've gone through a period where bad news was good news on the market. So you get this bad economic data and the market will go, oh, that's great because it means lower interest rates, which is better for stocks. So bad news was good news. And now we had bad news that was bad news. And then we actually that bad news is kind of not really the point. It was something else that was over here. And frankly, I'm not even convinced that might, is the culprit. It's most likely and almost inevitably a multivariate phenomenon with a whole range of different things that are going on under the hood that not anyone has one clear view on everything. So, but the culprit at the moment is the carry trade. And this tells you something about the global financial system where the Japanese authorities can raise interest rates by 25 basis, a quarter of 1% and crash the global economy. Like that's the world that we live in now. And you'd be right if you're out there going, what the hell has that got to do with me? And it's like, well, that's a really good question. And I said to you guys beforehand, it's like, yeah, let's talk about it. And then you kind of think, do I actually get it? I don't think I do, And then every time I pick at it, I feel like, that's what it means. Oh, does it? And I just keep going deeper and deeper and deeper. But shall I
give us a simple version? Yeah, try and go the simple version before you get into any other complexities that arise. But I think it's a really great point you made first of just how non-linear it is. It's like this tiny little butterfly flaps its wings, and
it's like the execution, the assassination of who was it, Ferdinand, leading to World War. It's just so, and it's always the way it goes. It's the straw that breaks the camel's back, and it's sort of like it was the spark that lit the fire, but there was a lot of kindling sort of going around. Anyway, so a carry is basically, there's all kinds of different ways that you can do this. A carry is just basically a positive carry is where you just get paid to put on a trade. And the way it works in this context is, as everyone knows, Japanese interest rates are essentially zero, and they're not zero in places like the United States and Australia. So I just borrow money from Japan. I get yen because I'm borrowing in Japan. I buy, let's say, Aussie dollars. And by the way, it's interesting because we in Australia, we're relatively, well, we're 2% less than the global economy, but we're actually a big participant in this trade. There's a whole different rabbit hole we could go down there. But so then you buy Aussie dollars and then you put that into Aussie bonds or even Aussie shares. And in fact, it's been happening in the US where it's not just US treasuries, but the Magnificent Seven and the QQQ and all of that kind of stuff, right? So even if, the perfect scenario here is nothing happens. I buy my US treasuries, I get my 5%, and then no FX movements, no interest rate movements. It's all good and well. Just to sit on this thing, I'm getting 5% annually. However, it's even more, and you think, well, that's kind of seems risky for 5%. It's like, well, hold my beer, says the hedge funds, because that's not risky enough for me. So what I will do is I will actually take 10x leverage and do it. And that way I'm getting like a really good return, which is quote unquote risk-free.
5% on infinite borrowing is an infinitely large amount of money. To be how levered you're willing to go, right? Versus your asset base. But they can borrow a very large amount of money.
It works for like a lot of trades, it works until it doesn't. And it's this kind of, it's a penny in front of steamroller kind of thing. It's like, yep, I'll clip that. I'll clip that. I'll clip that. Oh gosh, I just destroyed the global financial system. And that's very reminiscent of 2008, right?
So what went wrong? Maybe you want to unpack that a bit. Why that 25 basis point had such an impact?
It's more of a, well, I'm keen on your guys' insights here, and anyone listening, I'm just shooting from the hip here. So there's the caveat here. But the trade doesn't work so well, as you can imagine, if FX rates change. So if the yen rises quite steeply, it's sort of like, well, now again, I know people will try and hedge things here, but there are costs to hedging, right? Anyway, so it blows out the maths. And if you're not hedged, well, that definitely blows out the maths. So you've got change in the FX rate. And you've also got a scenario where the US authorities are trying, by the way, they'll never do it. They can't, they won't. They're painted into a corner, but they like to talk a good game and, we've got to raise interest rates. It's like, bless your cotton socks that you think you can do that. Anyway, so you're going to raise interest rates. Meanwhile, the US is lowering interest rates. And meanwhile, the FX rate is changing. So all of which just makes the carry trade far, 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 far less exciting. So Japanese investor, and by the way, Japan's it's just such a basket case in so many different ways, but they've got a huge amount of domestic savings and they like to invest in these things. But when that's not as compelling a trade, you might be tempted to sell your QQQs. You might be tempted to sell your US treasuries, and you might be tempted to bring that back home, thereby exacerbating some of that FX sort of issues and yields and all of that kind of stuff as well. And so that's what they did. People, and the other thing is the thing to remember here is there's a lot of people here who there's no choice for a lot of people. It's like, I might just let this ride. Doesn't matter. I'm not making as much money. It's like essentially margin call for a lot of these positions. Like, you got to sell, and you got to sell now. But everyone else is selling, and there's no bid. Too bad. Sell, right? And that's how these contagions happen and these catalysts happen. So I'll shut up and take a breath in a moment and let you interject. But basically what happened, that's the best read that I've got on what happened. So you've just got forced selling, makes the trade even worse. You get sort of momentum effects kicking in, you get margin calls kicking in, and everything starts to sort of tumble. Now, let's put things in context. Very quickly, we're talking about markets, but here in Australia, the all-time record high we're like 6% away from. Like, that's the crash that we had. And I think it's something like 60% of all years going back to infinity is basically, or negative infinity, I don't know how that works. We're going back to year dot, is that you will see a 10% correction also. So this is normal in the absence of things. So I think one thing, we've got a little bit carried away here, but two, it was a bit. Anyway, I'll shut up.
Yeah, but no, I think I think you summed up well. And so, the Japanese central bank raising interest rates, I think it was like the second time in 17 years. So it was a surprising move, I guess. Definitely surprised those in the carry trade. So that makes the carry trade worse. It means that because these people need to close the trade at some point and pay back the money, they now have to find more money to pay it back, basically, or they're kind of short because the yen's worth more than it used to be when they go to change it back. It also means, obviously, that zero has moved up, so it's less attractive, just the interest rate delta. And exactly as you're saying, it's like this information cascade is people sell to, they sell their US stocks or whatever else, or Japanese stocks to buy this. Yeah, that puts more downward pressure, which makes it worse for everyone else who's got the carry trade on. And it's that beautiful kind of spiral. But the craziest, I don't know, I'm something that's still, I'm not resolved about, because I do think that's huge. So how big is it? There's estimates of like trillions of dollars are on the, particularly the Japanese like low interest carry trade, because it's been so cheap for so long and so stable, borrowing there and spending elsewhere it's huge. And so that's why I think you saw such a big effect. But I'm surprised by how fast it's stopped. We're recording this on Wednesday morning. We had like a 12% fall on Monday and then a 10% rally in the Nikkei on Tuesday. So I don't know what that means, whether there's like still more unraveling to go.
I bet you there was some swaps opened up between. Yellen, here's the conspiracy, right? Yellen picks up the phone to her Japanese counterpart and goes, guys, WTF, like stop. Here's some funding if you need, whatever. Just don't do that again. Please, for the love of God, do not do that again. And the added context here in terms of significance, Japan owns something like 1 in 7 US treasuries, or something like, 16% of all government debt is owned by the Japanese. So here's the second and third order effects that kick in. So when they decide that they don't want to hold US treasuries anymore, they sell. And when you sell, you push up interest rates. Higher interest rates are not good for a country that is $35 trillion in debt and adding $1 trillion more debt every year. Oh, and by the way, that deficit's going to blow out massively because now you're not getting any capital gains tax and unemployment's rising, and there's it just feeds on itself. So, never waste a good emergency. And I think the authorities that would be always just sort of like, and I've said this forever, right? And I will die on this hill. You can say whatever the hell you want about inflation. It's going to take a very distant backseat to when it comes to sort of growth and supposed economic prosperity, because it's a devil's choice here. What do you want? Do you want to crash the economy, or do you want really high interest rates? Both suck, by the way. But what do you want? And they will always go for higher inflation. And so the can has just been kicked down the road, and we'll see what happens.
Conspiracy theories aside, I still don't fully understand, like, why is it that stock markets should tank when this carry trade unwinds? Like, is it people selling Japanese stocks to pay back Japanese debts, or is it
selling US stocks?
It can be both, but I mean, it could also be Japanese, right?
It was
like
Japanese
you can borrow in
stocks.
Japanese.
Japanese banking index was down 26% in 2 days. If you wanted to, like, the Nikkei's move was insanely massive. The banking sector in Japan was down 20. It lost a quarter of its value.
Yeah, but like,
2 days.
but why should it, like, is that because like the higher yen means that these companies are less profitable in yen terms? I guess is
so you borrow in yen, so you borrow at a low interest rate and you invest somewhere that's higher, and so one of those is taking it to the US, so you're then doing a currency conversion. You could also invest in other Japanese stocks which yield higher than the Japanese bond that you're borrowing in, and I think that could be some of the collateral that's being liquidated. So I think that's part of
and
it
could be like, I guess a secondary effect is everyone tries to buy yen again, pushes yen up, which pushes the stocks down in, like, their earnings are lower in yen terms if they have overseas earnings, I guess.
Yeah, that can be a factor too. And I think that's the contagion to global stocks is, as Andrew said, you can buy either bonds or stocks with them, depending on how risky you want to get.
Or real estate, right? Or, I mean, remember, you young whippersnippers might not remember, but did you remember?
Deleveraging.
It's a deleveraging. And don't forget, it's a good old fashioned scare. Like, what's the reason? I'm uncertain. And the market hates uncertainty. It's like, I'm just going to sell. Shoot first, ask questions later. Things are falling. I don't really know why. All I know is I need to get out, and I will get out at any price. I mean, it is the psyche of most investors, all of us, really.
If I may sum up for the simpletons such as myself, then it's essentially, leverage helps push up asset prices. You see it with property prices. You can borrow more money, so the prices go up. The guy next to you, you're competing for the house, he can also borrow more money. You're both borrowing more and more money, so you push the asset price up. When you suddenly have to deleverage, the asset prices come down. So you had a big deleveraging, stocks coming down. They're one of the assets that was essentially bought with the leverage. So that makes sense, on a simpleton level. I hope that's roughly right, rather than actually wrong. But
it's a good story, right? I'm going to just be careful to articulate. This is sort of one of the narratives that's going around. It's the one that I've sort of preferred. I don't know if it's true, but it sounds good. Sounds reasonable, right?
Well, and then of course there's the element of panic kind of creeps in, as you were saying, Andrew, and so that can exacerbate moves, panic, euphoria. They exacerbate moves in either direction and generally add to volatility. So I guess that makes sense. I'm going to run with that as my explanation for what happened for now.
I mean, so it's there's a bigger story at play here, which goes back decades, I think. Japan lost the war with the Axis, and, the US sort of stepped in and said, we're going to rebuild back. They did. They turned their wartime economy, they pointed that towards the production of consumption goods, electronics particularly, cars, other things. It's despite all its problems, it's the world's third largest economy. It's massive. It's an absolute powerhouse. And this is a culture which is like massively into saving, which is a good thing, right? I know modern economists tend to think that saving is bad, but they're into that kind of thing because they like to sort of protect themselves and plan for the future. And they had this massive trade surplus, massive excess savings. And they basically a big part of helping to fund the US sort of deficit. And what do you do with all of those? You're selling a bunch, very strong parallels with what's happening with China, but that's another story. But what do you do? You're selling all this stuff to America, this massive economy, they're paying for it in US dollars, right? So you got US dollars everywhere. It's like, I guess I should spend some of that or invest some of that. So I buy treasuries. So you indirectly fund the deficit. But you also go and you buy a bunch of assets with those greenbacks as well. And this was the thing in the 80s was Japan's buying the world. They're buying all the golf courses. They're buying all the property. As all the xenophobic sort of stuff came to the fore, and it was just, and then the property bubble popped and it fell flat in its face, and we don't talk about it anymore. But that is kind of what is going on here. I think at a larger system view of it here, you've got the US that has for a while had the reserve currency, and it has basically been able to use that to its advantage via petrodollars and via, trade relationships or whatever, to basically get other countries to fund that deficit for them for a long, long time. And it works kind of really well until it doesn't. Not that there's anything imminent, but again, directionally, there's a trajectory here that I would love someone to explain to me how this ends in a nice way. There's a lot to unpack there, Matt. Go for it. But passing the baton to you.
No, yeah, it's a very complex system. I think Michael Pettis kind of made me realize how complex it is. Like the economy isn't a household budget and stuff, so it's really hard to think how these flows all fit together. But yeah, basically Japan has engineered, like, we kind of put a lot of morality on it, although that Japanese people just like to save, but it's also just the structure, same with China, of the way that society is run as a financial repression to kind of take money from households and give it to productive investment, which then led to the bubble. But yeah, so I think
non-productive investment.
Well, it starts off productive, but
yes.
Exactly. Non-productive becomes non-productive.
So nothing wrong with productive investment. Do that all day long.
Basically, you have like a central government that just puts it all into capex. So you build heaps of highways and industry. Eventually that hits a limit. You start exporting a lot more, and then that goes to that consumer goods phase. And that's kind of where China has been for the last, since like 2009. After that, you start to hit another wall, and that might be what China's hitting now. But that's what Japan hit in like the late 80s and has been in this weird stage ever since. And just one other point, I don't know if that really was a point. I'm just saying how.
No, it's a great point.
It hits a limit. And
excellent point.
Is how these currency regimes get agreed. It's something Russell Napier has been talking about a lot. It's not really my main area, but
love me some Rusty. He's great.
He's very good. If anyone hasn't looked into his work, we've talked about it a few times. But yeah, he talks about there being a regime shift in currencies, and he talked about Japan. Actually, this is like a month ago, so I'm interested. I haven't caught up on his latest
I haven't seen
things.
That.
So I was just trying to check in if he's had any commentary on what's been going on. But he talked about kind of this implicit agreements that happen within currency pairs, and how that we could be shifting into a new one. So yeah, I don't know. All that's to say, I don't know what's going to happen next. I think for us, it's just focusing on the businesses and remembering why you own stuff, at least for me, because at certain points there can just be these. Yeah, I mean, if everything else is held constant and your share price falls 10%, that should make you like it more. And it's just a matter of keeping in mind. And also like investing on fundamentals, not just relative valuation, because if everything falls 10%, you probably don't like the business anymore if you're just investing relatively. But if you're investing on fundamentals, you do. So yeah, anyway, that's how I try and stay sane through it all.
And it impacts everything, right? Like, I mean, we spoke a lot at Infinitum on this very podcast about some of the valuations that are out there amongst tech and whatever. And it's just like, you get to a sort of like a Tina kind of situation. There is no other alternative. And I think credit creation is probably the biggest thing that no one talks about. And I'm not against credit creation, right? I think credit creation is a wonderful kind of thing. But when it is created and directed towards non-productive uses, it always creates distortions, and it always ends badly. If you're going to provide a bunch of credit to people to go out and create industry and more products and do it better, and just let the humanity and ingenuity do its thing, nothing wrong with that. That's how actually Japan did. That was the miracle economy. Early days of Japan and China and Germany, interestingly enough, post-war as well, they had very fractionalized banking systems, more local community banks, huge numbers of banks. We have 4, right, in this country, and it's going that way in a lot of other places as well. But when you have that kind of stuff and there's less implicit bailout assurances, you get a lot more, because banks are the ones who create the money, right? And you get a lot more prudent capital allocation through that process. And again, it's such a deep thing. And I'm not going where you think I'm going, but it is sort of like, if you want to understand things at a big picture, you kind of have to understand, like, where's the money come from? Who gets to say where it goes? And how well does it get used when it gets there? It kind of will explain a lot of stuff, from stock prices to the general state of the economy and employment, and a lot of things besides, and at least my perspective.
100%. Well, yeah, we touched on it already, but one other bit of news that we talked about but last week was DroneShield. So as we were talking about it, I guess like before our podcast was even came out, they raised 120 million further on top of what they'd raised just a few months prior. So now they're on what, $200 million cash pile, 240 odd million.
What a genius move in hindsight. I mean, again, I dip my hat.
Yeah, feed the ducks while they're quacking is the phrase 100%. In capital markets, right?
I say that not saying aha, but I'm just brutal. Like, reality of the situation is they are a lot more cashed up than they were, and than they ever could have been if they waited a day. Right.
Yeah. I mean, that's wild. I guess one thing that stood out to me was something that we talked about actually on the last episode, which was just how much DroneShield will need to keep investing in R&D to stay relevant, just with how much, because it's literally an arms race and it's a very new field of tech where it's not just building like a rifle or a helmet or something, which has been the same for a long time. They need to keep innovating just to stay current. And that was interesting because, of the 120 million raised, 90 million is for a technology development plan. And I think that
blew my mind. Yeah.
Yeah. I mean, people can see that really positively. Like if you're just on that first order thinking, you're like, oh, that means they're going to have really good technology. That's really awesome that they're spending this much on technology. But the issue is if everyone else is spending that much and, you're up against non-business actors, you're up against state actors. They're not trying to get a return, an ROI on a cash basis for their investment. They're trying to win a war, the amount of money that China could spend on drones is infinite relative to how much DroneShield can spend on anti-drones. So I think that is just something to keep in mind with this business, is that it's going to have to keep investing a lot just to, running to stand still kind of thing.
And the other misconception there is that we spend the money, we will get a return. Like anyone who's done any R&D, particularly in an academic center, most R&D yields squat. And not because people are incompetent, but you don't know what doesn't work until you try it. And so, I mean, how much has Meta spent on the metaverse, right? Now, maybe I'll eat my words and in 5 years' time, they'll be like the leading company in the world and everyone's living in Ready Player One type realities. But, that's a lot of money spent without any sort of payback there. So it's sort of like, it assumes that to your point, they'll outcompete others spending, and B, that they'll actually get something will come out of this R&D. It might actually be that nothing comes out of it.
I think that, from my perspective, what I'm mindful of with this huge raise now is that they had plenty of cash before, and this, the decision to raise another $120 million just shows to me comprehensively that this company has zero interest of making a profit anytime at all soon, which is super handy for it because it's never really had to prove that it even can make a profit.
I think it is making a profit though, right?
Okay, sorry. I mean, a sustainable profit, I guess. You're right, Andrew. It has made a profit off the back of those tailwinds that we were talked about in the last episode, basically. To me, it's saying we're not going to make a profit anymore. Basically, that's what I'm trying to say. So it's had this great period where it has turned a profit and then really become quite a prominent stock, especially also amongst sort of retail traders and people who may not be that guided by the actual fundamentals, by the actual, the valuation necessarily. They might more be looking at the thematic and the share price and the trade and the chart and all of this kind of thing. And, conveniently for them now, having just raised all this money, they actually don't even need to make a profit for a very long time.
It's not the raising of the money that irks me. It's the spending of the money. After day one, like let's say that I'll give your business 100 million, Claude. Now, and you don't just sits there. Like nothing's changed, right? Except that you've got incredible optionality now that you didn't have before. So your enterprise value didn't change, right? So that's not the problem. And I would say, but like to Matt's point, like what our cost of capital is very low. If we can raise it this, like, hell yeah, I would. I'll say it right now on this podcast. Anyone wants to lend me money under those terms, I will happily give some shares away and raise it. I actually think that's prudent. It's when you've got no good use for it and you're spending it almost for the sake of spending it and you're malinvest. That's the problem. It's not the raising, it's the spend.
Yeah, I think that's a great point, man. That's a good way to cap it. We don't care, especially if you're raising it at a relatively high price, right? Like, I mean, it might have been better to do it a month ago in hindsight, but still, they cashed in when they could.
I mean, these guys, let's remember too, these guys had no clue what was going to happen. They were dumping their shares at 70 cents. Right? On the way to $2.
Hey, good luck to shareholders in this one, man. It just
right.
Look, in other news, Matt, during the week, you've kicked off with an article. So, like, can you give us a rundown? Talk us through also the article you published.
No, yeah, it ties together a lot of stuff I've been diving into. So I found it quite hard at first to kind of get it to click all together because it's quite a few different things. But I guess the core is this idea of what you might call hemispheric theory. So it's the idea that we're over imbalanced towards our left hemisphere, which is this very rational, linear way of processing things and ignores that reality is far more complex than that, as we've already been chatting about some things on this podcast. But yeah, I kind of tied it back and it's starting with this idea of problem solving as like one avenue where this left hemisphere goes awry is seeing like a big complex issue and just focusing on one connection, like two nodes on the graph, you might say, and assuming that you can just eliminate one thing to improve the whole overall system. And one of the most shocking cases of that is Chairman Mao, a famine that doesn't really get much talked about because it's basically forbidden to talk about in China, but maybe 40 to 50 million people died, the worst famine in modern times for sure. And it was effectively a man-made famine where Mao targeted eliminating sparrows because sparrows eat grain. And so, that's one connection.
The logic
and
checks
literally
out.
Killed millions of sparrows, like people just chasing sparrows, to their death, shooting them, whatever they could. And obviously the effect in an ecosystem is that there's other attributes for any node. Sparrows also eat locusts and other bugs. Without the sparrows there's this huge locust plague, which was one of the main factors. It's always multifactorial. What happened to lead to this horrific, and I give a quote there from someone who researched it really well, a Hong Kong-based academic who did this incredible work on it. And it is like, the more
He's
you
now
read
in a gulag somewhere, probably, the poor guy.
It's one of the most horrific things you could ever imagine, basically. And so that's what it can go wrong in the extreme case. But it's actually something that I think happens all around us in society. We focus on the problem. If you look at politicians, it's always about this problem. And they try to make it really simple, even though we live in complex adaptive systems where it's never there's one simple variable to eliminate.
Like there's cane beetles. Let's introduce a cane frog.
Yeah,
cane
I
toad.
Considered talking about the cane toad as like an example, right? There's been millions. That's
a
like
good one, isn't it?
Yeah, that's like an ecological one, but it's everything around us, like almost everything that if you see most stuff around us that's broken, we have like an idea of what to do to solve it that isn't working.
Let's put up interest rates. That'll fix things. Oh my God.
Oh yeah, we can get, yeah, and so why does it not work? I think it's because we
make a new currency. That'll fix things.
Now you're talking my language, Claude.
I will not wade into that now. But yeah, it's this idea of the difference between a complicated and a complex system. And we tend to think of them as complicated, and complexity is very, very different. So I go into the article a bit about some of the properties of it. One of them being nonlinearity. So like a 25 basis point move in one government leads to trillions of dollars being wiped out,
for example.
And it goes the other way. So if it's nonlinear in the wrong way, you could spend, as you were saying, for maybe DroneShield might be what happened, or other R&D budgets, you could throw $100 billion at Meta's R&D and maybe not have anything to show for it, because it's nonlinear.
Meanwhile, this college kid in their garage comes up with something that just becomes, the thing.
Exactly it. And so I didn't really talk. I talked a little there about some of the investing implications, but I'll try and write more about that in future. But it's just this meta. It's kind of the big problem, I think, ironically, in our world is that we are focused this way. We try to treat things like they're linear, connected, kind of like can be put in a spreadsheet when they're more like a living, separate thing. And that's what I think we need. I think our right hemisphere mode of thinking, which Ian McGilchrist talked about a lot in The Master and His Emissary, and you can dig into that whole world. But it's a different mode of thinking that's more broad and sees the connections, not just the nodes. And that, I think, is what I'm really interested to explore. But yeah, I kind of see it as the areas in the world that aren't going. You can name literally anything that's like a persistent problem, like recidivism and jails. Like everything is. It's almost always that we're trying to treat a really complex system like it's
illegal immigration's another great example.
Mm-hmm.
Yeah.
Yeah. All of the stuff, or everything. Yeah. And once
let's,
you start
let's
seeing
put
it that
let's
way,
put people in a gulag. Speaking of gulags, and that'll stop the problem. Or let's ban drugs. That'll stop the problem. The examples are everywhere.
I actually think that the immigration example is probably an interesting one to apply it, because it's probably like an easy example to say where like the harsh, simple solution, like stopping the boats or whatever, it's a classic example of, well, it doesn't really fix the problem, and because maybe a more creative way to think about it would be to attack it from the idea of, well, how can we make it so that people aren't having to like flee a dastardly situation all the time, and how can we understand better how we as Australia or Western nations also fuel these crises where people need to leave? Because people have always left, right? Like, especially here in Australia, like we are, all three of us anyway, obviously, the descendants of people who are relatively recent arrivals in Australia. So, or in Matt's case, like the genuine immigrant himself.
I grew here. Matt flew here.
Yeah.
I like to say that
taking our jobs.
You guys are default Australians. I actually chose to be Australian. I think it's the point.
Yeah.
You guys just, it was just already ticked. You're like, yeah, okay, that's fine.
Literally coming here to take our job. My gosh.
Oh, you should be. You got to laugh, because otherwise you got to cry, right? It's so. Anyway, go on.
But I think that's an example. That's sub-optimizing for one system. You can say it kind of both ways, like using immigration to try and solve a problem to like get growth. I've had people talk about that as one as well, like
True.
to use one linear thing
You
without
can't grow GDP, so you're like, all right, here's immigration. Oh, no one can buy a house, so you're like, turn off the immigration.
And then the alternative, exactly, and then turn off the immigration when it's kind of like, actually the solution would be to have like invest in infrastructure and have all these people come and be productive and whatever else.
Yep.
So yeah, I think that we see it everywhere. I think you see it with like just medicalizing a lot of stuff. We treat it that you can just take a pill for obesity or whatever else instead of looking at the whole system.
Yeah, maybe put the can of Coke down, but no, that's not let's have an Ozempic pill.
100%. But yeah, anyway, we're writing a lot more about it. Took a while to kind of connect all these dots, but keen to see where they all lead to. And interested if you guys have any other thoughts on it, but that's kind of.
No, I loved it, man. I highly recommend, maybe put it in the show notes. I recommend people read it. I just think the lesson here is, I don't know when humanity is going to learn this lesson, but first, recognize what complex adaptive systems are. And when you see those things, just don't, can I swear on this pod? Don't fuck with them, right? Like, just that's why.
Now we're going to get like deranked on iTunes or whatever. It's over, guys.
I mean, this is why capitalism is so beautiful when properly enacted, is because it doesn't try to sort of stand over and control things directly.
I think that's it.
That's why it works.
It's not control, it's like nurturing. It's like a garden, right? Like you don't control where the plants grow. If you've ever tried to grow them, you realize that. Or kids, like you can't dictate every part of it, and that's where it goes wrong. But you can it's more, you can kind of nurture it.
Set the conditions. Set the conditions that allow things to thrive. Recognize that there'll be unintended consequences. Understand that part of these systems is a constant renewal and destruction, and that we just, as much as I would love to live in a world where nothing ever goes bad, we just don't. And so like, recognize that reality. And what's the saying? The road to hell is paved with good intentions. And it nails the concept that we're talking about here. I don't really think there's a cabal of lizard people that are, steering the global economy into a ditch. But they kind of, they're doing it because we want to fix it. We want, people are suffering. Let's give them some money. People can't afford a house. Let's give them more money. Like replete with examples here. Whereas really, if you really cared about people, you'd probably just stand back a little bit, and just try and build the guardrails as opposed to figuring it out. I mean, you speak of China, right? And what is the world? I think finally the world's recognized that, communism is like really great on paper. It just doesn't kind of work, and yet we sort of essentially control other elements of the, like whether it be interest rates or other things. And it's just sort of like, how is that ever going to work? With how smart do you have to be to know the inside of what's going on in everyone's head inside an entire economy and know how that's going to change over time, with 4 gazillion variables at play, and then probably allocate capital and pricing to that system? I would love to know how that, and yet we all crowd around our council of elders like we did this week. And Michelle Bullock said that she's not doing anything for 6 months. Like, oh, she can see 6 months into the future and she can predict all the, wow, that's really impressive. I'm sorry.
I appreciate you managing to talk about Bitcoin for 5 minutes.
I didn't mention Bitcoin. I didn't mention it.
Cool. Well, thanks for that. I guess since I'm the segue guy today, so should we touch on some babies, some stocks? When we were away, we did have quarterly reports, so I don't know. Feel free to chuck in any ideas if you guys had a quarterly that caught your eye. But I thought that sort of was a quarterly that I thought I'd touch on is Airtasker. Now, I don't know, surely you guys at least know what this business is and might have some broad thoughts on the business model. But look, the Airtasker result came out. They essentially, had a quarter that was negative operating cash flow. They do have positive operating cash flow for the full year. However, one thing that I think that it's really important to be mindful of with Airtasker is that they have done deals essentially that secure them advertising inventory in exchange for shares. So I think if you look back in June again, like while we were away, and this is kind of why I wanted to touch on them, because I just think this is like an interesting quirk that people who are looking at the stock, they might be like not aware of how this affects things. So what they've said is they've got a $6 million media partnership with Media, the outdoor advertising thing, and they've got a $5 million partner or media capital from leading audio company ARN to scale brand awareness and turbocharge growth in Australia. So essentially, Airtasker needs to pay marketing expenses in order to continue to get people to go to their website to find work or get work or what, essentially drive that network.
It's the Redbubble problem all over again.
Yeah, exactly. And by doing these deals, you sort of take out an expense that you would otherwise have to spend. So, it's still an expense to your shareholders. It's just, it's not going to come through like in the same way as just paying for the marketing would. So I would imagine that doing these deals will have a short-term positive effect on the reported financials. But at the same time, I actually see doing these deals as like a sign of weakness, essentially like raising capital and essentially ultimately likely to dilute or cost a fair bit.
And what does it say about their view of the valuation of the shares too, right? Like, you've got a choice in what you can use as capital, right? It was like, well, we're going to give this away instead, which, if I'm inferring it correctly, I'm sure they're not thinking of it like this, but if you were to think it through logically, it basically says that the shares are overvalued.
Well, yeah, that's correct. So
why else would you do if shares were at fair or undervalued, don't give them away or don't use them as money, right?
It's worse than that. It's worse than that as well, because it's not even shares. Like with the ARN Audio Media, it's like convertible note.
Sorry.
So so yes, it is. It can be shares if they decide to convert it, but
otherwise it's debt. Like, it's debt that they could get cash paid, or I see what you're saying.
Yeah, I think what you say is still true, Andrew, but I just thought I'd add that caveat.
No, it's
I think ultimately, yeah. So Airtasker has the option to convert the outstanding note into shares if it can't and doesn't pay back the debt at a 10% discount to the share price at the time, or repay the coupon in cash. So if you're a sort of believer in the stock, or you can be told, oh, don't worry, we're going to pay it back in cash, and that might be true, but they're setting themselves up to potentially dilute a discount, and even be able to do that even when the market, for example, might actually, if they tried to raise cash, want a discount of more than 10%. Well, this has sort of secured for them the ability to raise capital at a 10% discount. And yeah, so look, I don't know, I have a real reservations about Airtasker. Like, also, so this is, I guess, the thesis for the company would be that the website creates a little network effect in, you know, as you have more people doing tasks and more people looking for tasks there. And that might be true. We can discuss the strength of that network effect in a minute. But it definitely means that it's very hard for them to go and, like, they can't export that competitive market to UK and US, and, you know, they're spending money on growth in the UK, and yeah, ultimately, like, it's just, there's no advantage overseas. So, like, if there's any kind of competitive advantage that exists, it's here in Australia, where they might have a bit of that network effect going. And I think, you know, we've touched on it before, I'm sure, maybe a long time ago, but the problem with it is super obvious. It's just like, it wouldn't make sense really to continue to have an ongoing work relationship through Airtasker. Like, for a lot of the kind of tasks, if it's like, oh, I need someone to mow my lawn, like, okay, it might be useful for finding that once, but why would you keep on having that relationship through Airtasker? It doesn't really make sense. I mean, half the time people will probably want to mow the lawn for cash anyway. Like, the last thing they want to do is run it through Airtasker. Like, so I just think that, you know, it's the lifetime value of the customers that they attract that is probably the thorn in their side, generally speaking.
Yeah, I mean, I'd agree with that, Claude. You basically said what I was going to say. I think it's a much lower quality marketplace than, you know, like REA might be one of the higher quality marketplaces, for instance. It's one of the lower quality marketplaces. It's transactional. So even like you don't need to use them very often. So that increases the cost of acquiring a customer as well. Like if you only need your bookshelf done once a year or whatever, like if you're not using them all the time, you have to be reacquired as a customer. There's a lot of leakage because, as you say, why would you keep mowing the lawn like repeatedly? You'd just do it for cash and save their fee and save telling the ATO what you're doing, probably, for a lot of people. And also the quality is on the supply side. If you are a tradie or anything with something, the more that there's skill involved, the more you build up a book of business of people who want to use you. And the people that need to go and use something like an Airtasker to get work the lower quality people who can't build up the work. And it's different for different tasks, obviously, but the more skill, you're more likely to have an adverse selection problem. And I think that's a similar problem to Hipages has, where the people who need, particularly tradies that need to advertise for work, are typically either very young, starting out, or the lower quality tradies. Like they have some problem with them that they can't just keep the existing clients that they have. So yeah, all of those kind of conspire against it.
Good points. Follow-up question though. There's another somewhat similar business, Hipages, HPG, and that's, I think, as you touched on briefly, like that's more focused specifically in, I guess, the tradies kind of space. And the general thesis though would be the same, right? Like this is a website that's trying to be the classifieds, you know, that used to exist in the newspaper to an extent. Is basically my question is Hipages in a different situation because it's more specialized than Airtasker, or is it just facing the same fundamental problem? And I guess my second question is, why does it seem to do a little bit better than Airtasker?
Yeah, good question on better. I'm not sure. But I have looked at Hipages and thought the same thing. I think the quality problem's worse on Hipages because on Airtasker, at least, they're not like, you don't have like professional, you know, whatever, cupboard assemblers or whatever. Like there's such a range of little tasks on Airtasker that I think it's less of like a professional skilled thing. So there's less of an adverse selection problem. I think that's higher though on Hipages, where you tend to have people who can't get work being the people that you would least want to have doing the work. Yeah, I'm not sure what other stuff. I mean, it's got quite a different model. It does lend itself probably more to repeat business in some cases because people kind of build it to be their marketing engine. And it's kind of more supply focused, I think, than Airtasker. But yeah, I'm not sure if you guys had any other thoughts. I don't have much more.
I would say, I mean, if I look at them over the last 3 years, they're both down, 65 and 72% respectively. In an environment where the revenues have been growing, but the common theme here is that they're perpetually stuck in the priming of the pump phase, which provides a lot of cover for these kinds of models. Like, well, it's like Uber, like did it and kind of arguably pulled that off, and Airbnb did it. And it's like, we bleed cash, we get established, we become the go-to with the destination, and then everything kind of works. And they've never done it. So Hipages, Airtasker, revenues growing really well. Lovely. Losses continue. Like the more money they make, they either, you know, lose about the same or lose more. And the only way, Redbubble was the same. I mean, I I've got to go back and look at Camplify. But all of these ones, it's sort of like, yeah, we get it, guys. We get the model, right? But you've not demonstrated that it works without you having to aggressively prime the pump and put people in there. And it's like a lot of the food delivery businesses and the packaged up, those kinds of things. It's just sort of like when the golden, what's the word for it? The promised land is when it's just sort of like, I mean, REA Group doesn't need to tell anyone to go to realestate.com, right? They don't. You go there because that's the only place to go. And I see no evidence that these guys are able to sort of get to that point. Maybe they do, and things will change radically if and when that happens. But until that happens, it's just like all you're doing is just buying growth. And you can't buy for growth forever, particularly in a world where cost of capital is not as favorable as it once was, and the raising environment's not as favorable as it once was. So no, they just seem like slow moving train wrecks to me.
Yeah, I'm not going to have no real plans to invest in either of them. And I think it is because the marketplace isn't that good. As in, it's the competitive advantage derived from the marketplace isn't very good. However, I've always thought of, and I still continue to think of, Hipages as more attractive because of the more, and I could be wrong, and I think the point you made, Matt, is very interesting in the sense that the adverse selection is worse. But
Actually, Camplify is exactly the same now that I look at it. Sorry, go on.
The more professional nature of the tradies on Hipages then gives Hipages the opportunity to try and put them on this sort of software they have, Tradie Core, which is, I guess, supposed to be somewhat of like a business management, workflow management software sold to tradies. And that's the little thing that pricks my ears up for Hipages. The idea that they could use this potentially not very profitable sort of advertising lead generation model they have, but they could use that as something that they, don't really get much of a margin of, but that is perhaps the incentive for a tradie to sign up just on the time when they do need to get some leads, and then try and move them onto sort of some sort of business management or workflow management software. That I think is interesting. Yeah, that's why I think it's a bit better, and that's why I do have it on my watch list. But I've never gotten across the line because I've just never been completely sold on whether either of these stocks really can make a lot of profit. However, I do think I have to say I actually do still, no matter what, come down on the idea that I think Hipages is a lot better. Like it's had positive operating cash flow for.
It's also more focused on Australia, Claude. So like Airtasker is still trying to if you look at its Australian operations, probably profitable. It's just burning a lot of it and trying to win other markets, right? Like still trying to win in the US and stuff.
Yeah. And any way I look at it, I always just keep on coming down on the fact that I significantly prefer the Hipages angle, and probably the thing, right? So in theory, I'll tell you when I think Hipages could work, right? If we actually had a bit of a real slowdown, a bit of a recession, and for the first time in ages, demand was actually hard to come by for tradies, that's when I think probably the stock of Hipages would go down because probably stocks would be weak. And at the same time, it might actually really then get an opportunity to get people on, because actually otherwise, tradies that usually never needed to get work actually have to try and get work. So then they jump on the marketplace, temporarily probably making the marketplace a bit more profitable as well. But then maybe that becomes the in for them to sort of sell to these better, more successful tradies to sell their sort of lead management and workflow management software to them. And I think that's what interests me about it. I think I'd say a stronger balance sheet as well, better financials. There's a lot more to like about Hipages in my view. So look, and I always marvel, they're similar market cap, and it's just one of them seems so much better than the other one to me. It's just that I don't have enough conviction in Hipages to actually want to buy shares in that anyway.
A lot of maybes for that to go well, right? Like this might happen and then that might happen and maybe.
Yeah, exactly. I at least sort of also what if Airtasker, I just see scenarios when I might want to buy Hipages, but I just can't see any scenarios when I might really want to buy Airtasker.
Awesome. Well, should we wrap it there, gents?
Thanks for listening, everybody. Have a great day.
Thanks.
Cheers.
Bye.